Maurizio's question, doing some naked put screens, whether he was doing the weekly or the monthly picks of the day, Maurizio had said, where I'm seeing this very bullish buy come up, I'm not seeing a lot of naked put trades. How come? Oh, here we go. Oh, no, this is, let me just go with the monthly picks of the day. Fantastic. Oh, there's that lithium one I mentioned I was considering as a married put. All right. There's only 5 results. We're saying it's a very bullish buy, which means someone, you guys, an investor, sees that, might say, oh, well, now it might be a good time to do some good covered call positions, some good naked put positions. Let's see what they have on the search. Okay. They're saying it's a very bullish buy. We're anticipating a very bullish move, but I'm only seeing 5 trades. Why? In all of our default searches, especially the picks of the day that Ernie created for covered calls and naked puts, was based on testing that was done in order to find the best results over a given time frame with some basic other stops and other alternatives put into that. Okay? So this search here is specifically looking for stocks that are trading above the 50-day moving average. There's some other basic criteria, of course. Yeah, we want to be 6% out of the money, 40-cent bid price. You know, stocks here are no in a specific list on this one as well, which also hinders it. And as far as the weekly picks of the day go, for the naked put positions, we see only 4. Cassava, 5 below. Bristol Myers, Silver Wheaton. I had mentioned that I got into NEM. Silver Wheaton was a consideration. I think Pan Silver was the one I was also considering. I think that did better today than NEM did after I opened it, but that's okay. This is looking for stocks that are above the 20-day moving average. And of course, no earnings between now and expiration. What do we know from a previous discussion we just had from Mike about the 20-day moving average? Only $11, now 10% of optionable stocks, ETFs, and indexes are trading above their 20-day moving average. So when I run that naked put search and I go to the weekly picks of the day or the monthly picks of the day, I only see 4. What are these 4 that I'm looking at? These are the 4 that in the last 2 weeks, these are just 4 of the stocks of the 10%, around 400, 420, I think it's maybe actually 520 now, optionable stocks, indexes, and ETFs that are still trading above their 20-day moving average, still relatively in an uptrend or holding it, even though the market has been declining. That's why you're seeing so few results, because again, the market sentiment is sort of a contrarian indicator. We see these very bullish buys, it means that everything around us, everything of the general market, the put-call volume ratio is just about to go into bullish mode. So that would be 11. Number of days SPX up, gap over the SMA 20. All of these factors are all pointing to a bullish move, even though all of them are probably near or close to the lowest range they've been in historically over time. So we saw here that the lowest percentile was at 3.2%, March 20th, 2020. Makes a lot of sense, doesn't it? Only 3.2% of all optionable stocks, indexes, and ETFs were above their 20-day moving average at that time. That was right near the floor, about 323 or 324. Things started to move back up. Is it a guarantee? No. But it's what we've seen historically. And again, so it's going all the way back to 2008, where you can look at the histogram of the time here, or I can go to all. Yeah, I know that's just a jumble here, but of course what it's just showing you is what's happened with the indicators. You'd want to isolate that into a different time period. 2018. Why is this relevant? Because this was that December and November and October that was disastrous in 2018. Remember those last 3 months? It was looking good all year. The blue line is SPX, and then just didn't have a good ending to the year. But that's where these fences are set. That's why those indicators exist. Again, it's not a guarantee. We're not saying that tomorrow or 5 days from now or 10 days from now, you should expect a 5 to 10 to 15% move in SPY or SPX, QQQ or NDX, for example. What we're saying is that historically, once we start hitting these levels, very infrequently do they continue to go lower than they are now. They usually start to revert back up. And when you run a search that's a bullish strategy, even though you're seeing a very bullish buy here, but you're only seeing 3, 4, or 5 results, it's because you're seeing the stocks of that 10% that are still trading above their 20 or 50-day moving average, that are still offering a good naked yield, still have a good positive earnings per share growth, don't have earnings between now and expiration, the standards that I'd look for in a weekly or a monthly naked put, covered call, bull spread strategy, or so forth along those lines. So, for Mike, for Maurizio, for Ron, hope that answers your question. And for anyone else who had a question related to that, I hope that answers your question related to the market sentiment tool. Why is it showing a very bullish buy? Essentially, what does it mean? And at the same time, how would you use it? Now, let's just turn over to YouTube real quick, and I'm just going to use our search function here on our YouTube channel for market sentiment. There's a variety of different ones here that you can take a look at. Using the market sentiment tool for adjusting or placing trades, that was just from months ago. Current look back from 4 months ago. This one a couple weeks ago, I think this was from, that was from Max. Yeah, I was talking about using it for call and put buying. Not something I do, but we tried to address it as best we could. Let's see here. One of these was short, and it was actually really good. But in any case, quick review of the market sentiment tool. I think that's a decent one that goes through some of the indicators a little bit more. And there's certain ones here that go through individual one. In any case, yeah, back to August 2020, April 2021. There's a variety of ones here. Just go to the YouTube, go to the videos, use that search function, look up market sentiment, and you'll be able to see some of the other material there as well, in addition to what we'll have and what we'll post from today's discussion. All right, I think Ron had to leave, but after his first question, he later asked, he says, when you trade a bull put or burr call trade in only short term, less than 30 days? Yes and no, Ron. If I'm doing a bull put credit spread, many of you have seen these presentations before. My preferred approach to bull put credit spreads is looking for an 85% probability or higher. I'm usually doing the weekly bull puts and 14 days out in time, 11 to 14 days out in time, minimum return of 9%, but the average return is usually around 13, 14%. Actually, it's about 14.8%. This was a strong strategy and what we developed and what you heard me tout for most of 2017 into 2018, 2019, 2021, the first half of 2020, and the second half of 2020, as a matter of fact. I've only opened 7 or 8 of these it's 11 now. I've opened 11 of these in 2022. First ones were done in February, sort of near where I thought I was seeing a market indicator change to bullish, and I had to manage 3 of the first 7. The other 4 were later on after that June announcement, the glitch that was in the bullish buys run, and that's when I did that. So if I'm doing a credit spread, bull put or bear call, I'm looking for similar criteria. I want to be 8 to 17 days out in time, usually 11 to 14 days out in time, probability above 85% or higher. Returns I want always avoiding earnings between now and expiration. And yeah, I want that trend in my favor. Stocks above the 20-day moving average. That's why we're not seeing that many familiar names. Cassava, Bristol Myers, same thing that showed up in the naked put. Why? Neutral to bullish strategies. Similar criteria that we'd want to see that our historical testing has shown has worked best. Debit spreads, however, yes, a debit spread on Cassava. Selling the 31 call and buying the 29 call for a debit of around 175, 176, return of 13.6%, probably 85.6%, would be a parity trade to this Cassava bull put credit spread. You have a similar risk return, short period of time, good probability. I don't have any debit spreads. Hold on one second, folks. Let's go to other strategies. But a popular approach for debit spreads to get a lower risk-reward ratio, let's go to bull call, meaning to have closer to a 1-to-1 or 2-to-1 risk-reward ratio, is to go 30, 40, 50, 60 days out in time, Ron. Sell a call that's right at or maybe even slightly out of the money instead of in the money, and buy a lower strike call. We call it the at the money debit spread. And if I go into sample searches here, OTM, out of the money, out in time, bull call debit spreads. This approach is popular with the concept that I might be paying a debit of only 283 on, let's say, a 5-point spread. So the potential to make 217, I almost said 227, 217 on a debit of 283, closer to a 1-to-1 ratio. Investors who do these types of trades will normally look to close the position, hopefully in the first 10 to 15 or 20 days if they see the movement they desire in that situation, and they're going to try to close this, the max profit at 218, if they hit a profit of 109. They hit 50% or maybe even 40% of the expected max profit in the first 20 to 40 days, even though this position might be 60 to 70 days out in time. That's what many do with, and I've done, with bear put debits in 2022, mind you, not bull call debits, but did something similar with bear put debits starting in about mid-January and adjusting back into bullish spreads when the market sentiment gave me that slight trigger. Now, why would I not do this? If they're parity trades, why wouldn't I do this? This is a bull call debit. Remember, we're selling a call 112 days out. That might be a little bit too far, but it's a starting point. And buying this lower one, having a risk of 282 for a potential max profit of 218. It's about 77% potential profit on the position in those cases. Why wouldn't, if they're parity trades, why wouldn't I do a bull put credit spread this way? Well, the stock is at 284. We're selling the 285 strike, so we are slightly out of the money. But even if this call goes in the money, what do I have? I have a lower strike call that protects that position. If I get assigned early, I can exercise this long if my broker doesn't do it for me to close out of the position with the maximum profit. Did have an example of that this week, actually. A gentleman was in a bear put debit spread. I forget the stock. I think he had sold I think it was SPY, and I think he had sold a 395 and bought a 400. He got assigned early on the 395. It was for October. And his broker didn't exercise the 400 to cover the cash obligation to buy shares of SPY at 395. Well, he was trying to sell to close the put, and he wasn't getting a fill price, so he called up and said, hey, how would you handle this? And we walked through some ideas of asking the broker if he could just exercise the long or just maybe adjust the position or maybe roll it if he wanted to stay into a married put position. He ended up being able to close it for a little bit above intrinsic value. So he got out of the position okay. But you still don't want that to happen. So where am I going with this, Ron? My apologies. I wouldn't do this as a bull put where I'm selling an in-the-money 285 put on SPY and buying a 280 that's further out of the money, because if I get assigned early on this 285 put, I'm in a married put now, owning shares of stock at 285, having a 280 January put in this case to protect it. Maximum risk would still be around 282, but the net credit would kind of help against that because I'm doing a bull put now. But I wouldn't do this far out in time, out of the money, or in the money now, talking about a bull put credit spread, because I don't want to risk the early assignment. This at or out of the money farther term approach should only be done with the debit spreads, not with the credit spreads. Can you be successful, Ron, trading bull put credit spreads or bear call credit spreads 30 days out in time? Yes. Do you have to use this at the money approach for bull call debit spreads if you're going 30 to 40 days out of time? No. Go with the structure that makes you comfortable. My preference from what I worked with for 2 years, what I tested and what I traded, but mostly tested against 30 days out, 7-day out, 21-day out, is this structure. That's what I prefer to use for the credit spreads, with the probability 10 to 11 days out in time, looking for those types of positions. Again, with the trends I want for MACD, stocks above the 20-day, moving average, going in the trend that I want. Am I seeing a lot of trades now? No. Why? Because I'm only dealing with 10% of the optionable stock market, where stocks are trading above their SMA 20, and probably only 4% of those total stocks also have a positive MACD that I'm looking for as well. So that's sort of what you run into, but these would be the preferred ones if I was going into bull put credit spreads right now. I opened married puts, protective positions. Okay, I opened a married put. My apologies. I'm opening more next week. We're going to have a discussion, big talk with our Fusion subscribers next week in relation to that as well. So there's going to be more positions being opened in that Fusion portfolio. Why am I focusing on the married puts? Because, hey, as Mike G said, the market doesn't look right. You're saying very bullish buy. I just don't buy it and I'm scared. What is the only position I'm going to be comfortable opening if I think there's a chance that the sentiment indicator is correct and we might see a push up, but we still know there's going to be volatility. There's going to be ups and downs, Mike. I'm not saying this is going to be bullish for the next 3 months at all, and that's not what the market sentiment indicator is saying. Why wouldn't I open a position to take advantage of a bullish move that has an open risk to it? No, I'm going to open a position like a standard collar or a married put where I'm going to try to take advantage of a bullish move, maybe in the shorter term, maybe the next 10, 20 days, somewhere in that time period, where I've got a controlled risk of 5, 6, or 7%, ability to make adjustments outside of that nested trade with the income methods discussed in the blueprint, whether the market stagnates or the stock stagnates, moves up, or even if it moves down, I can look for some adjustments to do in that situation as well. I'm not buying calls. And I said that. Market sentiment indicator, very bullish buy, is not saying put all your chips into long calls and hold on for the wild ride. That is not it at all. Maybe protect some of the bearish positions that you have open. Maybe add a hedge if you're over leveraged on bearish trades where they might get hurt if the market does start to recover based on the market sentiment indicator. Maybe add a little bit to some of those long positions. Proper position sizing is key. Don't overtrade. If you feel that you want to open something, even if it's in a bearish trend, make sure you have proper position sizing where the true risk on a put you're buying, a bear put debit spread, a bear call credit spread, does not risk more than 2, 3, or 4% of your total portfolio value. That's how people get hurt. Proper position sizing is key. Controlled risk is paramount. Adding hedges when you start to see swings or anticipation of swings is also very essential if you're overloading on spreads, leverage call buying, leverage put buying, calendar spreads, iron condors. Whew. I don't know if anyone's made good money in iron condors this year with the ups and downs we've had. We tried to look at that too, and it did not look successful at all. But hey, maybe I had the wrong settings. In any case, neutral positions such as that. That's why I like the out of the money strangles for the last 9 to 10 months, because of the sudden moves up and down. You can take profits on one leg or the other. But as we showed in the beginning, not in a day or two. It's usually a longer term trade where you're looking a month out, 2 months, 3 months out as the target for your expiration, and maybe sometime in the shorter term, you might adjust those. I do want to go back to this bull call debit spread discussion for a moment. So I'd mentioned a popular approach that we all know of, we've heard about. There's other videos out there. Lord knows I'm not necessarily the best options educator, and Lord knows I'm not the only options educator that's out there. But we know that there are these ones, and they were very useful, going into the second half of 2020. These out-of-the-money bull call debit spreads were killing it. I mean, you were doing great. Almost anything you picked. And we're not there anymore, are we? But that's why the strangles, the strangles I've been leaning more towards. But in any case, you open this position, you look to close it 10, 20, 30, 40 days out if you hit a 20, 30, or 40% profit of what you expected. Usually the target's 50%, Ron, within a few weeks. I'm going to back to YouTube real quick. I want to show you something you might want to check out later on. It's 2 ways, I believe. There it is. This was selling puts. I'm sorry. Nope, this is the one I wanted. 2 ways to trade a strategy, bull put credit spreads. I'm going to click on this, and that's not what I wanted. Let's pause that. There we go. So in this video, Jerry brought us a way that he was looking at that was very similar to that out-of-the-money bull call debit spread, but different. What do I mean by that? He read about a strategy where he trades bull put credit spreads 45 days out in time, looks for a specific credit. I think it was looking for a 25% return or so, something along those lines. I can't remember. Less out of the money, lower probability, I believe, than I was looking for that 13, 14% return average that I was getting. In any case, he goes 45 days out, and he looks to close the position for 20 to 25% of the maximum profit in a third of the time, or about 15 days. When Jerry brought that to me, it kind of made me chuckle at first, but then we went ahead and looked at it, and what we found out is it's essentially the same thing, just a little bit more work involved the other way. What do I mean by that? We're seeing roughly, we were at the time, not in 2022, Ron, we were seeing roughly an 86, 87% success rate with our bull put credit spreads. And yeah, we have management techniques we use on those. We were holding them as close to expiration as possible to get the full profit, which was an average of around 14.6% or 14.8. I'm going to just give it 14.6%. And that was for an 11 to 14 day trade. And this approach was going 45 days out in time, looking for a net credit, I think, that was around $1 on maybe a 5-point spread. So about a 25, or some cases a 30% return, 35% return. But he's looking to make 20 to 25% of the maximum profit in the first 10 to 15 days. Well, 20% of 30% is a little bit less than the 14.6% we're making and averaging 11 to 14 days out for the same 11 to 14 days out time frame. Here we will close or manage these positions if necessary, but 86% of the time they expired worthless. Here was about the same success rate. I think he quoted 82 or 83. It might have been 87. I don't remember. But the return was slightly lower. It was about at 11 or 12%. And how did you get it? You had to actively close the position instead of just letting it expire. Was it profitable? Yes. Did it have a good success rate? Yes. Did it have a good return percentage? Yes. But is it really that much different than just doing the 11 to 14 days out to begin with? At that time, no, it wasn't. In 2022, who knows? It's been a rough ride. Every 7 to 8 days, there's a shift somewhere or some direction. We've all lived through it. We all know it. But in any case, I think, Ron, you might want to check that one out there. That's just a base discussion there on 2 ways to approach it when we felt, I don't know. To me, it's maybe I'll just go ahead and stay with mine for now. A little bit less work where I don't have to worry about closing positions early in those cases. Today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions, although we do post a few in Fusion. However, that should be opened as a married put and a married put only with protection in place. Options involve risk and may not be suitable for all investors. We got a chance to look at some of the search tools today. We took a little bit of a look at the portfolio when we were talking about the SPY straddle and linking over to the profit and loss chart to run our what-if scenarios. Looked at the market sentiment tool in depth a little bit. But if you like all the tools you saw today, remember at any time you can take a free 14-day trial. No credit card is required. Just needs your name and email address. You'll have access to the patented search tools and over 23 of the most commonly used option strategies. You can use our defaults as a stepping stone to create your own search based on your goals and risk tolerance. Access to signature tools, portfolio tools for tracking, managing, and evaluating rollout opportunities as well. After that free trial where no credit card is required, so you don't have to worry about being billed, subscription levels start at just $45 per month for the end-of-day data. That means that your search values that you're seeing in the search results, the portfolio updates are only done at 4:45, 5 o'clock at the end of the day. So during the trading day, you're seeing the previous day's numbers, calculations, and returns. The 15-minute delayed service is only $65 per month, so you get better updates. You also get full access to the picks of the day views, and you can have your search results emailed to you from any saved search you have or any default search that we have available for you. The historical tools just gives you full access to the backtesting tool, the search by symbol historical tool and strategy, and the option chain. Whereas on the trial, you just have about 2 or 3 months to look back on an option chain or for the search functionality as well. And of course, the real-time service, it's not streaming, but every time you refresh a search or run a page, you'll get the numbers and calculations at that instant. You can cancel at any time. There's no contractual obligation. Free coaching available on all levels of subscription. You can upgrade at any time as well. And of course, you'll have full access to the archives. If you're on a trial right now, you'll see that some of the more recent webinars say subscriber access only. As a subscriber, you have access to all of the ones as well. Speaking of which, you can go through the archived webinars at any time. Just click on the free webinars tab underneath the main home tab when you log on to your trial or subscription account. And of course, you can also go over to YouTube, as we showed a little bit today, to sort of review and search by presentations that might match your strategy goals, management ideas, and things of that nature. You can just search for bull put credits, bear call credits, bull calls, calendar, diagonal, poor man's covered call, and you'll see a listing of all our presentations that have that in the title or in the tag for those as well. Well, I did not see any last-minute questions come in. So if you do think of a question later on, remember, send me an email at any time to support@PowerOp.com or support@RadioActiveTrading.com. Remember, you can always call us during the market hours as well at 302-992-7971. Trial members and subscribers, of course, you can schedule one of those free coaching sessions at any time. That's essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site like we did today, but just on more of a one-on-one basis, or answer any strategy questions that you may have, management ideas, and more.